Investing in real estate is a great way to make passive income, but you really don't make a lot of money when you invest in single family properties. You make a lot more money when you invest in syndicates. My next guest talks about his journey of losing a lot of money in real estate investing in '08. He talks about the mistakes he made. Then he talks about pretty much a 10-year time period of trial and error and eventually creating a fund. He runs his own fund now that helps people invest in large syndicates. And with that, he talks about returns that can be like on the low end, we're talking 18%, and on the high end, between 30 and 40%. Really impressive returns compared to other real estate investors I've had on this podcast. Okay, if you want to learn more about real estate investing, this is a good one. Please welcome Patrick Grimes. Patrick, welcome to the show.
Hey, glad to be here. It's a
Yeah.
topic that's very near and dear to my heart, and I'm looking forward to diving in with you.
So Patrick's calling in from Hawaii. It's 7 a.m. He's up bright and early. Thanks for joining me here. And first thing I like to do is have people kick us off and tell us about your background. So why don't you take it away?
Yeah, I woke up before the sun rose, which was a good carrot here to get on this show because I had a beautiful sunrise as I ran around the golf course here. Thanks for letting me join while on vacation.
Absolutely.
I started out as a machine design, automation, and robotics engineer. Probably like many of your listeners, a very busy professional. Was doing successful, started earning substantial income and bonuses, and then was looking for where to invest. And I was in stocks and the market, and I'd asked the high tech owner of the company I worked for, what should I do and where should I invest? And surprisingly, he told me to go invest in real estate. I said, "Why?" He goes, "Well, high tech's a kind of a rocky, bumpy road. And you should diversify and get into real estate." His only regret was not to do more sooner. And so that's how I ended up building up a real estate company, some ups and downs, trials and tribulations, lost it all in 2009 and 10, built it back, and then eventually became full time. And so now we have a private equity firm with a bunch of apartment buildings, oil and gas wells, doing a bunch of recessionary buys right now, and we're a debt fund as well.
Nice. Thanks for the context there. Before we jump into your current business, I want to talk a little bit about the transition. I like to drill into that a little bit. The reason is for people out there listening, it can be harder for them to make that transition. Like, how do I make the leap here from my 9 to 5 to kind of doing what you're doing? So it sounds like you were working full time. You got into real estate investing. How long were you investing in real estate before you went full time?
Long time. So back in 2006 and 7 is when I really started approaching real estate, and I invested into a pre-development, all my own money, all leveraged, and I lost everything in 2009 and 10. So it took me a while. I was still gainfully employed robotics automation engineer, and it took me a while to financially recover from that. I went back to math. I got a master's in engineering and an MBA. Changed companies, started doing very well. That's when I dove into single family, and I was moonlighting it, to answer your question. So I was working full time and traveling around, putting together one of a kind automation systems and programs. And by night and by lunch times and by early mornings, buying stressed properties, collaborating on the renovation of those contractors, and refining out and holding them and repurposing and analyzing more deals. Actually, it was when I met my wife that I decided I needed to take a break because I just couldn't hack it. It was brutal. It's like the American dream is to become a landlord, but man, if you're making a lot of cash flow at your primary job, then adding another one of landlording was really tough. So I was back into automation. Took 2.5 years before I kind of retooled and we got married. Then to get into larger apartment buildings where I could partner up. And that's when I started to see a work-life balance because I could work with better, more experienced professionals in various markets. And we started taking down bigger properties. I went from 3-bedroom, 2-bath to 86 units. It's a big jump.
Yeah.
In my calculus, there's nothing valuable in between. The economy of scale, the risk, it really, take it above 80 units, you might as well stick to 3-bedroom, 2-bath. But now they're 200 and 300 units. But once that started happening, it was about 2 or 3 years down the line from there where I started to see the ability through partnering with other local operators and individuals that I could potentially walk away from engineering. And I didn't want to. I am a geek at heart. I've always been that way. But as the voice still in my head echoes, and Dave, the guy who gave me the original advice to jump into real estate, he said it was real estate that's really going to provide that financial security for your family, and he was right. Although I was doing well in automation, it was time for money and bucket money, right?
Yeah.
And passive income avenue for me was in real estate, and now in oil and gas, and now in diversified
Hmm.
non-correlated investments, in addition to the stocks and portfolios, right?
Right.
So well-rounded. And just so you know, I look at my passive investor guide. It does show the allocations of the wealthy, and 26 to 27% is in real estate. So it's not all of your portfolio; it's part of a well-balanced portfolio. But yeah, and it was 2 or 3 years before I became a contractor, and that gave me more time freedom during the day, and that was really important. Being able to control my daytime, because when you get really big into something and you're working with players that this is their job, they don't want to be talking to you in their morning or their evening. They want to be talking to you when they're working because they want work-life balance, right? So I had to transition to a contractor type role offsite, where I had more ability to work on investments during the daytime, and I could squeeze in the automation and robotics evenings and weekends. And after I did that, it was only a matter of time before I could walk away from engineering, and that's what happened.
Nice. So just to lay this out on a timeline, uh, 08, 09, you lost it all. You really went all into your full-time career as a automation engineer. Um, and then when did you officially go full-time?
Yeah, so let's see, let me add them up, because so yeah, about 2012 was when I got my master's, finished my master's degrees, started it and did a gap year, did 2 gap years abroad, but did a gap year and then came back. It was 2013, 14 when I started building a single family portfolio.
Hmm.
And then it was, I think, 2015 or 16 that we started scaling, looking towards larger apartment buildings.
Hmm.
And then it wasn't until just a couple of years ago that I shook off the engineering. I think during things got real slow in real estate during COVID. So I was doing a bunch of COVID automated assembly test kits. But after that dried up, and I could always go back. It's in the back of my mind. I could always go back and live a happy life. I really enjoyed the engineering stuff, but we're in Hawaii right now. So, you know,
Yes,
very different.
enough said. So it's about a 10-year time period to go full-time.
Right. Well, actually, it wasn't my plan to ever leave engineering. I was just looking for
Sure.
diversity.
Gotcha. No, that's an inspirational story. Good for you. I know, some people out there, they have that fear. What if I lose it all? Well, it's not the end of the world. It's you learn a few things and then you apply forward. And sounds like that's what you did. Let's drill into that a little bit. So, what were some of the biggest lessons learned from that? Losing all your money and then later starting your own private equity firm focused on alternative assets.
Yeah. Well, so the way that I did it the first time was I was a snot-nosed engineer, very aggressive, looking for the highest returning deal. I actually have articles. I write for Forbes. I've got articles on asset protection, Patrick Grimes, Forbes asset protection. I got single family versus multi. I've got lots of articles to talk about how I did things. And I just did one on Patrick Grimes Forbes recessionary acquisitions, the upside from downturns, to talk about how I did things wrong, and to try and unveil how you can do things right. But I had gone like I had gotten huge loans, and personally guaranteed, signed it on in my own name, put it in my own credit. And it was on a development, something that didn't cash flow. It was on a pre-development, something that even wasn't ready to build yet. And so I was hoping to really get the full appreciation. But when you buy something that doesn't cash flow, but you have to pay on a loan, you're hoping that the market will stay stable enough so when you get to the other side, you have something you can sell or something you can rent. And so turns out that if you don't do that and you're personally guaranteed, in your own name. And if you don't get sued in the meantime because somebody tripped and fell or something, because I bought it, man, not even in an entity. The lenders came after me. When the property went upside down, they came after me because I had cross collateralized, as they say, by it. It's what you do with your single family home too. You sign on your own name, your own credit, cross collateralized. So all my other assets were at risk. And so I didn't buy in I didn't buy assets for cash flow, like cash flow on day one. I didn't buy income producing
Mm,
assets in recession resilient markets. I didn't even know what recession resilience was. And I didn't know what recession resilient asset classes were. Like there are some investments that we learned like during COVID that will tank, right? There were some assets that like workforce housing and B and C class apartment buildings that stay strong through recessions, essential needs, right? And so I learned how to get lower leverage debt that's not personally guaranteed, that's collateralized by the asset. And that means that even the bank believes this is a really good deal and they're willing to just take the asset if something goes wrong. It means it's very unlikely something would ever go wrong. So I learned how to be able to use my and when I reapproached it, I wasn't doing deals in the same markets. I was actually doing them in places like Houston, where if you look back on the past recessions, a steady, slow sloping growth
mhm.
market just leveled off for a couple of years before it started going up again. And in other markets like Phoenix, Orlando, it dropped out 14 to 15 years before it broke even again, right? So if you look for those markets with diversified employment, ones that have strong recession resilient employers, you can find markets that will stay strong. They're tax advantaged and landlord friendly, then
All
they
right.
tend to have people coming and moving to those places, including businesses. So you'll have that steady state growth. So it led me to a very different tortoise, not the hare. Don't try and double and triple my money. Be much more calculated. Do my homework. And I'm an analyst by nature, so I just applied similar tools that we do, automation and robotics, to real estate at that point. And once we figured it out, it was just a rinse and repeat.
Very cool. I love that. Some of the key takeaways there is don't buy properties that are not cash flow on day one. And I really like the call out there to finding properties in areas that have employers. I've had a lot of real estate investors on this podcast, but none have phrased it this way is you want to be investing in areas that have employers that are recession resilient. So right, what comes to mind, because we're big into investing in stocks and we like to look for companies that are also, resilient to recessions. And I remember Walmart was pretty resilient as like when tough times come, people are gravitating towards buying cheap stuff. And when we're in good times, they're buying lots of cheap stuff. So it's a win-win. I remember researching the recession of '08. McDonald's actually performed well as cheap food. It's not very good for you, but um, people would gravitate towards McDonald's. And sure enough, their share price did actually pretty decent. So, yeah, great lesson there. Very logical.
I love that you said it's logical because in my mind, it just comes down to evaluating markets and trends, as you
Mhm.
say. I was on a panel on economics in Chicago. And what I thought was really cool about, speaking of '08, is all the other guys that were on that panel had gone through '08 and really struggled. And I felt like people that can get up and talk about economics today in this kind of climate when things are a little bit unstable, there are people that have been through it before and this is not their first rodeo. They see
Mhm.
so your recession resilience is absolutely right. In building diversified income streams and recession resilient markets and asset classes, cash flow and appreciate. I'd add in tax advantage as well. Has been our mission, and that's our investment thesis. I think that's got us to the point where we have a great solid portfolio where we can ride out this recession. But during this recessionary time, deals are structured very differently. And I think that's what's really cool too, is the ability to pivot to where you create a product that'll ride out a recession if you're in the right locations, the right asset classes, structured in the right way. But our current funds right now, the recessionary income fund, the real estate asset backed debt fund, takes advantage of the really high interest rates right now in this market. Takes advantage of the fact that the banks are pulling back in this market. We can cash flow in a very low risk way on first position debt. High interest rates. We're originating a 13% interest loan plus 2 points on a 50% loan to value. property. And it's incredible cash flow for very low risk premium. And our recessionary acquisitions fund does the same. It looks towards being the financial relief to operators instead of through gap or bridge loans, but just through acquisitions. We're just paying in cash for properties. We can get in there and make a return on the buy. Forget holding and renovating and improving. Right now, there's performing assets with distressed operators that are struggling. And we can just swoop those up in cash and get a great deal and then refi out, buy another one, sell the first one, buy a third, and compound. And so the ability to win in this recession or the upside of recessionary, upside of downturns, recessionary acquisitions and lending is really what we're leaning into right now. It's exciting for me because I was raked over the coals 2009 and 10. Guys, I didn't have a recession resilient portfolio. I wasn't positioned to be able to pounce. And all of our investors, they all want to know how to win from the downturn. Because they know in 2009 and 10, there were billionaires made because they bought right at the right time. And this is that time. And so we have a lot of interest there.
That's awesome. To back up a second, I do have to call this out. Your story is similar in the way that we've had people on this podcast that invest in real estate, and they've all graduated from single family and duplexes on up to large syndicates like what you're doing. You said 80 units for a property, and sometimes more, like you probably have some larger ones, but we're talking hundreds of units property. It's safer, steadier income. It's a great place to be. So that sounds like you're completely done with the days of doing single family and these small onesie twosie opportunities. Is that correct?
Yeah, I was actually joke the other day that these single family homes I was so proud of, they're now more of an annoyance to even have to sell off because, and I did my first 86 unit. It took about the time of 2.5 single families.
Wow.
The scale is just out of this world. And maintaining and owning it. I don't have to have a me, myself, or a property manager run all over to each unit all over town or in many towns. I have with 80 units, you can have on-site property management, on-site leasing, on-site maintenance. So you get that economy of scale. Instead of me chasing the property manager, they're giving me a report every Monday.
Yeah.
The loans are big enough to where you can get Fannie and Freddie loans that are very low interest rate because at that point they're income, cash flowing, producing companies essentially, and they'll give us a non-recourse loan. So it's a safer debt. I don't have to put your own name in it. You can put it in an LLC, and you can have the property collateralize itself. That way, you're not cross-collateralized anymore.
Right.
And I have an article like Forbes, Patrick Grimes, single family versus multifamily. I address a lot of this, the asset protection component as well. The gurus on TV that talk about flipping, and I got into reading books. Not from TV shows, but it's glamorized. What people don't realize is that you're risking all of your assets every time you do one of those deals where you're signing on the note yourself, signing on the debt, signing on the property yourself. And it's for a quick, easy win. Took me a while. It took me 2.5 years before the analysis paralysis guy was comfortable graduating to a private equity, larger acquisition, learning a new industry. I feel like that was my third master's degree, but the one that really mattered, right? But then the principles applied to other industries. Once I learned how to diversify, oil and gas, like I said, and private lending. And we have another one coming up. I'm not going to talk about it right now, but another asset, non-correlated asset that is appreciating tax advantage of cash flow going up.
So let's get into the numbers a little bit. We have investors on the podcast, some may be accredited, and that's exactly who you serve. You serve the accredited investor. And let's talk about the real estate first, and then we'll jump to the oil and gas opportunity second. So with the real estate, what is the minimum investment size?
So all of our investments have always been for accredited investors at 100,000 minimums. I've always had it that way.
Got it. And when you invest in the real estate fund, what kind of annual returns can the investor expect?
Well, traditionally, say for the last 3+ years, our large syndicates, which were a large apartment building, as you say, 200 to 300 units usually, those would yield some around an 18% internal rate of return
Oh, wow.
year to year. Now during um, this specific time, our recessionary acquisitions fund, which is not a single property in a single fund, we're raising capital where we quickly pounce on like whack-a-mole these opportunities that come up where we can make the return on the buy. We don't have to buy it and slowly improve. We just bought a property that was $4 million. It appraised right after we bought it at five, but the property was 6% occupied. When we don't put any capital into it, but to lease it up, it'll appraise at eight. But it was a distressed operator, the owner that didn't know what he was doing, was distracted, and we were able to swoop it up, closed in 14 days after we finished due diligence. So those kinds of investments, those kinds of opportunities were not around 2 years ago, 5, 10 years ago. Those are around now. So the recessionary acquisitions fund looks to make outsized returns just by buying right, not by any long-term risky hold or improvement, operations improvement. And so the returns for that are higher. In fact, if you look at the case studies, we were able to almost double our equity in a year on average for the four that we did outside of the fund before we created the fund. And we're on our way there. So the returns on that are 30 to 40% average annual return over a 3 to 5 year hold.
Wow. Wow.
And we're on our way there. And people associate risk with return sometimes. But also in real estate, if you're buying right, that's a very low risk proposition. You're not hoping to execute a business plan to make your return and you just do it on the buy. It's something I can easily calculate. And that's why we're very confident in those, and the proofs in the pudding and the acquisitions we've already done. Just happens to be this very unique time. In 2 to 3 years from now, I don't know if I'll be able to do this because I couldn't do it 2 to 3 years ago. So that's the recessionary acquisitions fund. And normally these are returns that are double what they used to be.
Yes. This podcast episode is sponsored by Ticker. Ticker is a platform that helps you manage your own investments with confidence. Check this out. Let's search for Apple. You can see Apple is on sale. That's looking good. Score is 61 out of 100, and margin of safety is 75%. Higher the score, the safer the investment, and the higher the margin of safety, the higher potential returns you can make. In this case, you can see the share price is 175 as of the recording of this video, and the upside potential, the fair value, is 398. All right, let's look at a different stock. We'll go to GameStop. In this case, GameStop is overpriced. Scores 39 out of 100. That's not looking too good. And the margin of safety is 0%. Here's some other features within. You can create your own custom dashboard. I like to set up and take a look at the top gainers and losers in the last 24 hours. I also like to take a look at the top search stocks, but you can really customize the dashboard to whatever you want. We have stocks, ETFs, crypto. This is a big one. We have a watch list tool that allows you to add stocks to the watch list. And if anything changes, such as that score or margin of safety, you automatically get notified. I call it the set it and forget it feature. And then we have portfolio trackers and alerts. So if you're looking for strong stocks, want to avoid bad stocks, and learn how to invest, I invite you to join Ticker for free. Just to pause there for a second before you go to oil and gas. With other guests I've had on the show, average returns, usually the expectations about 10% per year. So the 18 on the low end here, and then just to rephrase this correctly, that was 30 to 40% with some of these properties.
Yeah, so 30 to 40% within the fund and a 3 to 5 year hold. Yeah, and we're already on the way there, and we just did it 4 other times. So that's the reality of where we're at.
That's very good. This is outstanding. Now, these properties, where are they located?
In recession resilient markets, the same exact strategy. We use specific markets, mostly the southeastern states and Texas, a little bit in the Midwestern heartland, and very narrow targeted places where we see recession resilient, diversified employment.
Got it. Got it. Okay.
And we pass through tax advantages. That's traditional to real estate. So
that's what we talk about with our audience. You know, if you want to kind of use a tax strategy. Stocks, you could make some like you can make a lot of money in the stock market, but then if you sell your shares, you're gonna have to pay taxes on that unless you can go into real estate. So it can work very well with investors in the stock market. If you also at some point get into real estate, I am very interested in syndicates. After talking to a lot of guys like yourself, my interest in single family duplexes, any of that, no, not at all interested.
Yeah.
No.
Well, you can get the similar returns as owning large apartment buildings by being a limited partner
Yes.
in an apartment building without any of the risk. And so I talk about that too. And you don't have to trade time away from your family, friends, and hobbies like I did when I was slaving away at single family.
Mm-hmm.
Limited partner, you're limited to risk of the capital you have in the deal. And oftentimes we can refi and get that capital back to you pretty quickly.
Yeah,
So,
that's great. Let's dive
so
into the oil and gas. What kind of you said 100,000 in minimum investment. What kind of returns can investors expect?
well, so we're not doing oil and gas right now. We launched two funds last year and they're on their way, and the returns are traditionally higher, but there's a risk premium with oil and gas. And like I say very frequently, the intention behind oil and gas investments is to a couple things. One, get an investment where you can write off your ordinary income. So a lot of investors look at that write off as a significant return. In fact, the first fund had it was an 86% paper loss in the first year off your ordinary income, and the second had a 90. So you invest 100. If you're a dentist, doctor, attorney, you've got 100,000 in ordinary active income. In that first year, you invest 100,000. That first year, 87 to 90% gets written off as an intangible drilling cost. So you don't pay taxes on that piece,
Mm,
which is huge, right? Now you have more money that you didn't give Uncle Sam that you can then put into another deal. So that adjustment of ordinary income, a lot of the high income earners, that's why they go that way. Now it's part of a diversified portfolio. So you don't want to go all in energy or oil and gas. It happens to be really good timing. Oil tends to be really high, and we saw that market trend and we jumped on it. My family collects from an oil trust from my great grandpa Kaiser. So we've kind of been in the industry a little bit. So I don't recommend anybody jumping in without knowing what they're doing, but it happens to be a really good time. And we foresee it only growing, especially with the inflationary trends that we're at right now. That tends to hit the energy space. And what's happening right now with the BRICS is that it's only driving oil prices higher. So uh, we saw the projections on that are north of a 10% cash on cash return and a 2 to 3x multiple over 3 to 5 years, which means you have an exit. So you have this big discount on taxes, solid cash flow that builds over
yep.
time because it takes a while to deploy the capital, drill wells, and make it happen. And we do diversified funds. So we're not so worried about any individual well working out because, we have a larger strategic plan for building in multiple basins, drilling in multiple basins. So that's how that works. And those are a great piece of it diversified. And really, it's think about the energy, food, and housing are what the government subsidizes. That's where they need us to invest. If you go buy a Ferrari, they're going to tax you on the money that you use to buy the Ferrari. Then they're going to tax you on the Ferrari because you're not helping the economy. You're not helping the government. If you invest in these housing, food, and energy, and also medical, and I've actually got some other things that we can talk about there, but these ones are where the housing and food essential needs where you can get significant tax advantages. I'm very much a proponent of a calculated diversification play into energy. And if people are interested, certainly opt in because we have more funds coming up. We're very strategic, and the timing of when we launch those, when they open, oftentimes we'll get 20 to 40 million dollars, and we'll close it real fast. So those are ones that it's very asset focused, very opportunistic focused. So those are ones you want to get lined up or teed up for.
Sure.
The other asset that we do have open right now is the real estate asset backed debt fund, which is an income fund.
All right. Talk about that.
Well, just like the acquisitions fund, right? It's because it's actually called the recessionary income fund. Then we have the recessionary acquisition fund. And normally I wouldn't be saying, hey, let's go buy mortgages. I wouldn't be saying, let's go buy asset backed debt because people get like 5, 6, 7% taxed income on that, right? And it's just not my traditionally, it's not what I'm interested in. It's a very safe return traditionally. And so you'll see that if you look at the Tiger 21, which is 20 plus million net worth group, they actually publish their allocation. They have 7% of their wealth in fixed income. And that's not tax advantage, it's fixed income. So oftentimes those are in these, senior secured notes and these asset backed type debt funds. And you're in a very safe position in those because we're, for example, targeting 50% loan to value. Real estate can sway 50%, right? Now, and you won't lose a penny as a debt investor. Maybe the common equity would get completely wiped out, which is what happened in 2008, but many of the lenders were safe in that. Now, what happened during this time is a couple of things. What you used to get a very low risk investment for at 6%, 7%, right? Became 8, 9, and 10% because of interest rates rising. Same asset, same loan, same property, 50% loan to value, performing, cash flowing, experienced operator, high net worth, personally guaranteed, same exact risk profile. Now you're getting twice the return. Then what happens is the regional banks that tend to loan on these properties, they begin to have liquidity issues and they see some banks collapsing and some pencils down, and they part of the reason is started buying bonds that now are no longer worth as much as they used to, and so they're selling out bonds at a discount. There's a lot of reasons why banks are destabilized. So what does that mean? That means there's a bigger demand. So what you used to get 5, 6, 7%, now just with interest rates, you can get 8, 9, 10%. And with the demand, because banks take 60 to 90 days and they keep retrading, or they one day say, no, never mind. We can do 11, 12, 13%. And we actually have a 14% we're looking at for the same underlying assets, right? Because we will move quick and they can trust and rely on us. And so we're looking at a loan right now, which is 50% loan to value, 13%, 13% interest rate plus 2 points. It's amazing. That's like 15%.
That's great.
A 6-month loan plus a 1 point extension. It's 17% in the first year. Strong personal guarantee, strong cash flowing asset at a 50% loan to value. So that opportunity at a time when it's harder to cash flow in real estate because interest rates are up, taxes are up, insurance is up, inflation has driven our costs, it's shrunk our cash flow, right? You can invest lower on the capital stack, senior secured position in real estate on the debt, but get almost 2 to 3 times the return for that same risk premium. So that income fund is a real estate asset-backed debt fund that allows you to take advantage of these extraordinary returns that we can get in asset-backed debt. It's a diversified pool of gap and transactional loans. And that's what the income fund is all about. And we call it the recessionary because, again, 3 to 5 years, it will probably be back down to 6 or 7% return.
Sure.
But right now, it's just an incredible time to talk some amazing cash flow.
Sure. And just to rephrase back to you how this works, because this one's a little newer to this podcast. You essentially, you're raising funds from investors to almost become a lender. You're lending to maybe a developer, a real estate developer who's going to either develop a new property or acquire property. And by being the lender, by being the bank, everybody's making these returns, as you said, could be 15% plus another 2 points, so 17% the first year. Is that essentially what this model is?
Yeah. So now we're not a bank per se, because banks are actually a very different construct, but we're a private lender or a private equity lender, which puts us in a whole different category. And we have a lot more flexibility, and they don't force us to diversify in ways that cause these banks to collapse. And we can, but yes, we're raising capital into a pool, and then we're an originator. So then we get requests through our company, PIM Rapid Lending. And we then request for loans. We underwrite those loans and we issue those loans. And we're building a diversified portfolio of those loans right now. And from an investor perspective, if you want to invest in the fund, the returns are uniquely flexible because of the way that our loans work. Some are short term, some are longer term. We offer a range of different investment options. And this is going to be unique to you as well, probably. Because there really aren't a lot of people out there doing this. But because I believe in fulfilling that asset allocation chart that's in our slide decks for the wealthy, you need to have a percent fixed income. You need to have percent liquidity just on the sidelines. You need to have private equity. You need to have real estate. I keep getting questions from my investors. Hey, I've got 100 to some a million, some $5 million in cash sitting in the bank. And they're worried about investing it into something because they're in fear. And I would say, well, hey, let's put it in acquisitions fund. But you still need, because right now you can win big time from the recession there, but you still need a place for your liquid capital. Where are you going to put that short term capital that is losing money with inflation? If it's in a Wells Fargo, Citibank, or Chase, you're getting a 0.01%. And if it's over 250K, you're not insured, right?
Right.
And if it's in a brokerage account, you're probably getting 4. A high interest rate bearing account, you're probably getting 4, right? You're not keeping up with inflation. Published inflation is above 4 right now. Actual inflation that's not adjusted by all these fake indicators is closer to 7, 8, 9, 10, right? So where are you going to put that capital in a senior secured, safer position where you're going to at least keep up, if not beat inflation?
Right.
Right? And so we give these options for investments in the debt fund. Because of that, I really want to be part of the solution here. So we have one option, which is a 90-day note, senior secured note. We have a 180-day note and a 1-year note. What does that mean? That means you can put your capital in only for 90 days. And if you want to keep rolling it forward, 90 day, you can. You can put it in there for 6 months. If you want to keep rolling that forward, or a year, keep rolling that forward. And in that sense, you could be 90 days out from your capital at any time. That allows people to then say, okay, I'll keep the reserves that I need to feel comfortable without fearing that I'm losing with inflation. And that 90-day note right now for a limited time, typically we're offering 7% for that. But for a limited time, because we're doing we're originating high notes, we're giving 8.5% annualized fixed interest on that 90-day note. We're doing 10% on the 6-month note. It's insane, 10%.
Wow.
But look at the loans we're originating right now. Now, it may not renew that high. It may renew that high, actually. I think it's going to renew that high because we're seeing $1.5 trillion commercial real estate debt coming due by 2025. This is only going to increase for the next 2 to 3 years, in my mind. And then we have a 1-year, which is an 11%. So it's senior secured, fixed income, monthly distributions, or you can reinvest for compounding. You don't need the capital. Just do it through your IRA. It's amazing, or self-directed 401k, because then it's all tax-free too, or in cash. But so those fixed secure, or if you're interested in jumping in for 3 years, we'll partner in the upside with you, because you may be asking like, hey, if we're giving 8.5, 10, and 11% to these short-term notes, where's all the upside going? Well, so if you jump in for 3 years, we'll partner with you on that. So we'll give you, if you jump in for 3 years, we'll give you right now Class A shares, which allows you to participate with us, and I'll give you a 10% preferred return. Plus, we'll split all the upside, your investment upside and all the notes upside. We'll split that with you. And those returns are high. Those returns are high because, if you're willing to stay in longer, it's a different allocation. Short-term notes,
Sure.
Much lower risk, and then low risk membership units with upside. You got to stay in for 3 years. And so that's how that's made up. And we've seen a lot of interest, people buying the 90-day notes because they have cash in the bank and they don't want to be more than a couple months away from it. People buying the 1 year because they're like, I'm not really going to spend this for a year, and it's better performing than my CDs and my brokerage account. I want 11% right now.
Mm-hmm.
It's coming in. And then some individuals are like, you know what? We're projecting 12.5% on the 3-year hold, but we've beat that. So we're beating that like by a margin. And they're looking at that saying, hey, that in a senior secured position, lower risk, much lower risk than buying a place. It's actually returning higher returns than buying a place right now. And it's the first position on the capital stack. It's the first person paid, and it's insulated from the market volatility right now because it's a common equity that will lose. We can always take the asset. So we're seeing a lot of people shift from equities debt on that aspect on the membership units. Cool. So that's what the income fund is. It's a little complex.
But you know what? This is a good segue here to where people can reach you if they're interested in getting involved in any of your investment funds.
Yeah, so passiveinvestingmastery.com, passiveinvestingmastery.com. If you're interested in a copy of my book, you can go to passiveinvestingmastery.com/book, and we ship it out signed as a free welcome gift to anybody interested. And persistence, pivots, and game changers. I kind of share my story and hope to inspire others along the path. And on that site, we have our recessionary income and acquisitions. I also have my calendar. And part of what I love about being full time is I get to talk to investors where they're at. Big passion for that. We have a series of educational webinars. We do alternative investing series. Jump in and register for those. We have some really cool people. Our last panel was we had a laundromat guy, we had a self-storage, we had an ATM, we had an oil and gas. We all just got on there and duked it out, talked about all the different ways you can invest in alternative investments. So jump in there. Either way, happy to educate and also discuss investments and get you pointed in the right direction.
Awesome. All right, Patrick, thank you so much for your time. This is great.
Oh, I've enjoyed it. It's a really good chat.
All right, we'll see you.